In the next session, we would be dealing with the financial reporting quality. This session, or probably the next couple of sessions, are primarily targeted towards uh, the manipulations that are possible in the financial statements, both in the P&L as well as balance sheet, as well as the cash flow statements. So there's a strong focus on the quality of the financial reports. Quality is nothing but what is the potential of they being manipulated, or what are the various warning signals for us saying where the financial statement could have got manipulated. What are the various pointers which we can use to say that there might be a possibility that this statement is tampered? So some of the initial assessments on these aspects are being covered as a part of this session. The first thing is, see, on the income statement, on the P&L statement, what we are saying is the end result that comes up is nothing but net income, which is the profit after tax. Some companies may look at overstating it. Some companies may look at understating it. There are different motivations for doing both of them. Sometimes they could be done within the scope of accounting standards. Sometimes they could be done slightly outside the scope of the accounting standards. There's a thin line of difference between the two. So wherever a company is doing outside the scope of the accounting standards, we are calling it as a fraud or manipulation. But coming to why someone wants to manipulate the financial statements. So when we are talking about overstating versus understating, there are different motivations for both of them. When you are talking about overstating, the main reason is share price. Analysts, they always say, to maintain the company in the good books of the financial analysts, the more profits I show year over year, quarter over quarter, it may so happen that majority of the analysts will recommend a buy recommendation on the share price of this company. So see, though there are various aspects of financial statement to look at, some of the primary aspects which every analyst will look at is the profit. A base analyst who does not have too much of in-depth understanding of financial statements, who has a basic understanding, he may look at the profit as a number, the net income as a number. Oh, this company's net income is increasing year over year. So probably we'll give a more and more buy rating. So the analyst expectations, to meet the analyst expectations, and also from a debt covenant standpoint, we have seen that the as a part of the bond indenture, as a part of the covenant, the lender might put a restriction that your current ratio should be something equal to this, or probably your return on asset should be equal to 15%. So if my net income has gone down, I would not meet my lender's requirement. So either he may ask me to pay back the principal because I have not met the requirement, or he may charge a higher interest rate also. All are possible. So just to showcase those kind of things, so it could be either out of greed or out of pressure, right? Probably if we see here, oh, there is a pressure from the analysts, right? Probably the analysts, okay, let's say you are the analyst. You have given a buy recommendation on this company shares for almost 100 of your clients, right? Suddenly, when the profit of the company goes down, the analyst reputation will be at stake, right? So there could be some kind of pressure from the analyst also to maintain a higher profits. Second, from the lenders, there could be a pressure, or if it's not a pressure, it could be a blackmail. If you don't maintain this much of a ratio, probably either we may ask you to pay back the entire loan. These are mentioned at the prospectus layer itself. So to make sure that no such issues come up in the middle, the companies may trend to show higher profits. And sometimes management salary is tied up with the profit, right? With the P&L statement, probably some percentage of the final profit is what you will get as an increase in your salary. So they want to show a higher number so that their compensation, their salary will increase accordingly. So there are different motivations. There is a greed angle in some of the cases, and there is a pressure angle in some of the cases. But at the end, these are some of the motivations which will make any person to over report the earnings in the P&L statement, net income in the P&L statement. Whereas some companies try to under report the earnings to get some kind of trade relief and subsidy. Right? My profits are completely down. Look at my P&L statement. I'm almost running into losses. So give me some subsidy. I can apply for a trade relief. I can apply for a subsidy from the government. And even I can negotiate some terms with my creditors. You give me a 30-day more credit period. I'll pay it back to you after 30 more days. Or even with the labor unions, I can negotiate a salary. Right, this year we have not made enough profit, so probably you bear with us for one more year. Next year we'll increase your salary. To negotiate such kind of contracts, they can't even tax reliefs and all these kind of stuff. Or sometimes it's even more a game now. This year, this quarter, companies wants to show a lesser profit or probably a loss. And next quarter, they want to show a higher profit. With this, what is that they are trying to showcase? We have bounced back. From a loss scenario, we have created a huge profit scenario. Probably we have bounced back drastically. Rather than saying we are more or less constant, they want to showcase that kind of a feeling. Okay, even in one quarter, the company was slightly bad. Now they are bouncing back drastically, which means the company has a very big growth prospect now. They want to intentionally showcase that movement. Right? The impact is much more. From a loss scenario, you are again going back, but in reality, it's a manipulation. So these are some of the reasons why companies would like to understate their earnings also in a period. So overstating and understating, as long as they are not within the lines of the accounting standards, it's a fraud. Right? Probably a company may switch from straight line depreciation method to a written down value method. As long as they can justify or declining balance method or some other depreciation method, they can very well move on to. As long as they can justify what is the motive behind it. See, these all probably from a FIFO based inventory, they go into average cost based inventory. There's nothing wrong in that. But as long as they justify what is prompting them to go for that kind of a movement. Right? But these are all within the scope of the accounting standards itself. So they are not considered as fraud. But, okay, this year's revenue showcase as the next year's revenue. Or this year's expense showcase as the next year's expense. These all are coming under the fraud category. Probably an expense which was incurred on 30th March, which should go into the current financial year. They'll make a date adjustment of 2nd April and show it in the next financial year. These are the things which go as a part of the fraud in the financial statement, because as a part of the financial statement, it is only up to 31st March. So anything on 30th March transaction, they'll try to put it to 2nd April or 1st April so that it will come only after one more year. Right? Those are some of, we'll see what all could come into that category. So that is where those kind of things will reflect the quality of the earning which a company is actually creating. So the accounting principles, whatever the company is selecting, if they are misrepresenting the economics of the transactions, which means probably they are, suppose the asset whichever they have, it's good to use a straight line depreciation for that kind of an asset, but they are showing it as a double declining balance method, or probably a double declining balance method is more appropriate for them, but they are showing it as a straight line. So the accounting principles, if they are not in line with the usage of the business, then typically there is a low quality that is associated with the earnings. In some cases, the estimates which the company makes are completely unrealistic. Probably when every year they are getting 3% of the goods back, they estimate that only 0.5% of the goods are coming back to showcase a high revenue. But in reality, they are getting back 3% every year. So sometimes aggressive and unrealistic estimates the companies will set, which is what actually will contribute to the low quality of earnings. And as an analyst, we need to identify any such kind of quality issues are there with respect to the earnings of the company. And that is where we get into a HR related aspect called fraud triangle. What motivates, what is the typical fraud angle? So initially it starts off with either an incentive or a pressure. Every fraud which we see in the world, the starting point is either there is a incentive associated or a pressure, right? Either you will get something more benefit, or your boss is putting pressure on you to either show some higher number. So there could be some threat from third parties or whatever it is. So it all starts from there. Companies' profits are probably, as I said, there is a possibility that analysts will put some pressure. There is a possibility that the management will put some pressure, or there is a possibility that your salary is tied with the profit. So there is some incentive or pressure to every fraud that happens. And once you have that, you will look out for an opportunity. When should I make a manipulation? What is the typical opportunity? Okay, depending on, is there a possibility that I can get into a department where my boss is weak, where I get full flexibility in terms of data manipulations, right? Or probably in some department the boss is strict, in some department the boss is not so strict. Can I get into such kind of department so that I can do the manipulations to my comfort level? Not too many controls present internally. Or probably if I have multiple reporting, I report to this person versus this person. And probably in those kind of cases, some opportunities can arise to actually create some kind of a fraud. And the third part is the most important part, the rationalization part, which most of our politicians do very smartly. They will never say we never have done fraud. They will always say the others are also have done it. If others are doing it, why not I? There is nothing wrong in me doing it because the others are also doing it. So that is what is the rationalization part, which is you try to come up with the deed, whatever you have done is right. That is when you can commit a fraud. It's an attitude related stuff. You convince yourself that doing this is not wrong, right? Even if I am caught, I can very well say there are so many others who are doing the same, or what I have done is not illegal. So those are the typical rationalizations that come, which is more to do with the attitude, the mindset. If someone doesn't get convinced with that, No, that person cannot commit that kind of a fraud. So typically, like ethics, person if he is okay, he's not bothered about ethics, right? Probably if he thinks, oh, I'm ethically doing something wrong, he will not commit that fraud. Only when he is able to rationalize himself, saying, oh, what I am doing is not wrong, or even if he is doing wrong, there is a rationalization angle. Only then he will be able to do the fraud. That is what we are calling as a fraud. So probably earlier also there are so many legal and regulatory violations, but nothing has happened till date. So let me also do it. Earlier also so many people have taken bribe. So let me also take it. Doesn't matter. So that is what is the rationalization angle that comes up. When everyone is taking it, there is a very less chance that I will be caught. So those are aggressive commitment to third parties, right? So probably I can very well, oh, I know how to manipulate it. So I'll give a huge commitment to someone else. So all these are coming under the attitude side of it. So only when these three things come together, then only there is a possibility of a fraud. And okay, from a analyst standpoint, how to identify these kind of manipulations in the financial statements. Some of the most common things which have been identified as a part of our reading is, okay, there could be some kind of manipulations in your revenues. Aggressive revenue recognition. When you have to recognize it next year, see, you will be making a sale on April 2nd, but you will show it as you have done it on 30th March. Only 2 days difference. Or 31st March. Only 2 days difference. But it is coming into the current year's revenue. But if it is taken on 2nd, so you will manipulate somewhere saying that the sale is actually corresponding to 31st March, not 2nd April. Suddenly this year's revenues are going up. Next year's revenue, you have to wait for one more year for that P&L statement to come out. So sometimes the revenue recognition is more aggressive. When something has to be done for the next period, you are treating it in the current period itself. That is an indication of manipulation. Different growth rates of, this is a very important area you have to focus. Cash flow from operations versus net income. Your net income is showing a big increase, but cash flow from operations is either showing a small increase or showing a fall. An alarm for the analyst that something would have got manipulated. Because net income is purely from accounting perspective. Even if you have not got the cash, you can show a higher revenue. Whereas cash flow from operations is from a reality standpoint. So if it is suddenly a big difference, last year the difference between the two is very small, but this year the difference between the two is very large. Net income is very, very high, but cash flow from operations is very, very low. Either positive or negative, but it is very, very low. That difference is an alarm, first of all, for an analyst. Something might have gone wrong. So just let's dig a little bit more deeper. So that's where the ratio corresponding to net income to cash flow from operations. This is a very important ratio which will analyze the quality of earnings. It should be more or less consistent, and both of them should be more or less equal, or probably this should be more compared to this. Even if this is more, it should be for 1 year or 2 years. It cannot be forever. And that too not too much higher. Those kind of things we have to recognize. We have to see whether any such kind of things are happening. Abnormal sales growth. When the whole industry is growing at 5%, you show your revenues are growing by 30%. Might be possible. There is nothing to deny there, but it's a pointer, right? When the whole industry has grown at 5%, you are showing your revenues are growing by 30%, which is not, which is very much possible, but verify. Did it really grow at 30% or was it a manipulation? Because when all the competitors are growing at 5 and you are growing at 30, obviously, probably you must have done really well or you must have manipulated. So just verify and confirm. That's why we are not saying they are fraud. We are saying they are warning signals. Right? Just be alert and try to dig a bit more into it. Abnormal inventory growth compared to sales. They are showing as if the inventory is very, very high, but sales are much, much lower. Which means they are showcasing as if the revenue that they are recognizing, right? They have purchased so much of raw material, there is a possibility of a very big growth. Compared to the growth in revenues, they are showcasing a very high growth in the inventory. All these things are, and even, this is one more, non-operating income move into the operating income. What is non-operating? Interest income, dividend income, the income on the sale of asset, gain on the sale of an asset. You take that as operating revenue. Overall, the values don't change. Overall, your profit is not changing. But the operations part is improving drastically. Oh, company is very strong at its operations. Because you have moved an non-operating profit into operating profit or a one-time profit, like extraordinary items kind of stuff. You are moved them as operating revenues. Next year, you may not see that much of profit at all. But this year, you are showcasing it as if even the next 10 years, you will see that much of profit. These are the various areas where you can see the companies manipulating their financial statements with respect to revenues. With respect to expenses, the opposite, delaying expense recognition. When the expense is supposed to be for this financial year, they'll showcase it as for next financial year. So this year expenses are lesser, profits are higher. Right? Same thing, operating expenses they'll put as non-operating expenses. So still operating profit is much, much higher. Operating expense, they'll try to put it under a non-operating expense. Overall, it will not have an impact, but in the middle, it shows as if operating profit for the company is drastically higher. Again, an analyst will come in and say the ratings of the company are much, much better. These are the various motivations. Similarly, one more important aspect here is LIFO liquidation. See, what did we talk about LIFO here? Whatever the items that are purchased last, they go into your cost of goods sold first. Right? So, which means the very old purchases, they go into inventory. Very old purchased items, they go into inventory. So, what is happening here? Let's say the prices are rising drastically. If the prices are rising drastically, the inventory will be a very small amount because it will talk about the old prices, old items at old price. Inventory is very low, cost of goods sold will be high. Now what the company will do is next year, it will not purchase the raw materials at all. So what happens? This whatever was the inventory, this will come into next year's cost of goods sold. For the next year, see, last in, first out. If I am purchasing some more raw materials, their cost will go as cost of goods sold. But if I am not purchasing any more raw materials, the very old ones will go into cost of goods sold. But that's a very low value. So my cost of goods sold suddenly goes very much low. Profit shows suddenly higher. This mechanism is called as LIFO liquidation. The LIFO method, wherein you are not purchasing, that's the reason IFRS has stopped the usage of LIFO. because companies can manipulate this way, and in 1 year they can showcase a very high profit, which will make the analysts feel, oh, this company has bounced back. But what they have done is a manipulation, right? So these kind of things are very common warning signs for the analysts. So abnormal margin, comparative margin ratios like gross profit margin, net profit margin. Let's say if your company is having 20%, whereas the industry is at 10%. Any of the ratios, your company is deviating from the industry average by a very significantly large percentage. Better investigate a little bit more into it, right? It's nothing that every time it's not fraud, but these are the pointers for us. Any ratio, the company's value is significantly different from its competitors, it's a warning signal for us, which will prompt us to actually dig a little bit deeper into the financial statements and probably get into more and more investigation into it, right? So estimates changing very drastically. Last year the estimates were okay, 3% of the goods will come back, whereas this year they have changed the estimate saying only 0.5% of the goods will come back. Suddenly it will increase the profit this year, but that is also being treated as one of the manipulations which the company is doing. And typically year-end surprise, which is nothing but last quarter, 3 quarters the sales are in a particular region, but fourth quarter suddenly the sales have gone up, or fourth quarter suddenly the expenses have come down. They are all called as year-end surprises, because anyhow you can push it to the next year, right? The expenses they'll try to push it to the next year, the revenues they'll try to pull it to the current year. So just to meet the analyst targets and all, in the final quarter they try to do some kind of manipulation, as if they got a big project in the final year, in the final quarter. These kind of manipulations typically do come up. And the investments wise, they will showcase equity method of investment. What is this equity method of investment? Cash wise, see, I'm giving you some shares, or I'm taking some shares, I'm investing somewhere, right? That investment is on a percentage basis. It's not like a loan. See, company investing in some other investments, but that investment, see, okay, if I have purchased some shares of some other company, I should get the dividend or something like that. But the way I will showcase it is, I have invested in that company, in a loss-making company, in the form of equity form of investment, which means whatever, okay, I'm taking a 30% stake in the company. So I'll not get any dividend. I'll get only a share of their profits. So because of these kind of scenarios, I can very well manipulate my financial statement. And sometimes off balance sheet financing, like if it is a capital lease, I'll show it as operations lease. Though it's a capital lease, I'll show it as an operations lease. The assets and all don't go up drastically, so my ROA and all are much higher. So some such kind of manipulations are done. And as an analyst, the moment we understand all these aspects, we can even control these. Or you see, as an analyst, we are not bothered about the reporting side, whether the company is reporting as per GAAP or not. As an analyst, our objective is more to assess the health of the company, right? So we should identify for all these kind of surprises or warnings that are possible in the financial statement, make our own financial statement by adjusting, removing, adding these kind of manipulations that are possible, and based on that assess the health of the company. That is what is the most important thing. which an analyst is supposed to do.